You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Presented by NYSHAX.
Hi, everyone. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen and a guest, Don Davis. Lars, how are you doing? Where are you calling from?
I'm doing great, thanks. I'm calling in from the island of Timor in Indonesia.
Wow, that sounds far away from where I am.
Oh, yeah. What is it? 13, 14 hours off from you over in the States.
Oh, wow, yeah. Far trip. Well, Happy New Year. Don, glad to see you. Glad to have you on the podcast. Happy New Year to you. How are you doing?
That's a tough act to follow, saying you're in Indonesia, because I'm in boring, Virginia Beach, Virginia. But nonetheless, things are going well. Happy New Year to both of you, and excited to be on the pod today. Thanks for having me.
Yeah, we're excited to have you. So today we're going to do a little bit of a hybrid episode. We're going to do a year in review, talk about what happened in 2025. We'll also, of course, talk about the latest news, and we'll talk about what we predict also for this upcoming year. Look at our crystal balls and see what's upcoming. So let's go ahead and start off, as always, with rates. Lars, where are we at in the market?
Yeah, the market ended the year, again, as we've seen most of the year, somewhat mixed. If you're looking at the quoted rates from SCFI, again, mind you, due to all of the holidays, the rates we're looking at now are the ones that came out here in late December. SCFI quoted rates are continuing upwards, whereas the actual paid loaded rates, a little bit more of a mixed bag. If you're looking at the Pacific rates, especially into the West Coast, what we're seeing in particular is at the aggregate a little bit up, but it's especially Southeast Asia that right now was driving a rate increase here in the lead up to New Year, whereas China not really driving all that much. So again, we're ending the year, what we've seen most of the year, with paid spot rates not quite following the quoted rates and with significant subtrade deviations when you look into especially the Pacific rates.
Seems like that might be a trend that will continue because we've been seeing that over the past couple of months at least, where we're seeing deviations between the different subtrades.
Yeah, and one thing that we're seeing, which we have also seen quite a few times over the full year 2025, is a significant difference between the 20 and 40-foot rates. I think for those who have been in the game relatively long, as most have heard this rule of thumb, at least on the Pacific, that 20-foot rates are usually 80% of the 40-foot rates. But the quoted spot rates show at times massive deviations from this, and again, also massive deviations on subtrade levels. What we have seen, for example, over the past year is especially 20-foot rates. When you look at the subtrade, Northeast Asia at times have seen significant spikes that we didn't see in Southeast Asia, that we didn't see in China. So when we're talking about rate developments, especially shippers of 20-foot, and again, we should be mindful here that 20-foot containers are a minority of the cargo that moves in these major deep-sea trades. But the 20-foot rates are not just an easy equation from where the 40-foot rates are. There can be substantial market differences there as well. And I think that's maybe something we don't talk enough about, because we tend to talk about especially the 40-foot rates because most of the cargo does move in 40-footers. But for the 20-foot market out there, it's not always that easy. It at times also just comes down to, is the equipment there? Is it moving on slightly different corridors than what we're seeing from the 40-footers? So yes, we're seeing significant differences, but that is also the norm that we have watched during 2025.
Yeah, really interesting stuff there. It seems very nuanced, and I guess you might not necessarily expect that when you're looking at the different rates. Awesome. And are there any updates on the tariffs? Was it quiet over the holiday season? Are there things that we need to be paying attention to?
Well, it was indeed quiet over the holiday seasons, but once we went past the holidays, then we went right back into tariff news territory again. For those that don't remember, the plan was that the U.S. would increase tariffs on a range of various types of wooden furniture here from January 1st, in some cases from 25 to 30%, in some cases from 25 to 50%. Furniture does make up quite a bit of the Trans-Pacific volumes. 1 or 2 days before implementation, a new executive order went out, and these tariffs are now postponed by 12 months. So now they come into effect 1st of January 2027, which again, if 25 is anything to go by, we're never going to see this happen actually 1st of Jan 27. Something is going to happen and change the landscape long before we ever get to that date. Yes, Tariff changes, again, par for the course. And what is par for the course again is announcements of changes, in this case, changes of changes, which is 1 or 2 days of notice.
Yeah. And Don, I'm curious to hear from your perspective, especially, throughout 2025, there was obviously tons of news about tariffs and how they were changing. How do your shippers tend to react when that happens? Do you get kind of a mixed bag of people either pushing freight forward or deciding to hold back some? Just curious to hear your thoughts on that.
Yeah. And before I answer that question, I might just take one step backwards and just talking about the current market condition a little bit, because what we're seeing is we're starting to see upward pressure on space and capacity. Now, Zim largely operates on the Asia to US East Coast market, so we might be just looking at things from one perspective. And to give listeners a perspective, Zim is the 4th largest carrier on the Asia to US East Coast segment. So, but we are seeing some improvement, and this was more or less expected as we head towards the Lunar New Year. It's a bit later this year. It was understood that it might take a little bit longer, but as we look at the booking cycle, it's been stronger than we had seen, and that's with the holiday break. So it'll be interesting to see how things are going forward. As far as the impact of tariffs, I think the big thing that that we've observed is that shippers have told us that they've changed a lot of their sourcing patterns. The uncertainty has just caused a lot of problems for them in their supply chain. And many have gone to more of a just-in-time setup as far as their ordering pattern, which is a departure from what we saw last year. And because of that, you're not seeing as much demand as you might have seen at the same time last year. But what we are seeing is an increased demand for priority services. So we run 2 services from Asia to the U.S. West Coast into LA. So we're not playing in the whole space on the West Coast. We just operate on the priority service segment, which is competing with EXX and Matson. And there we've seen very strong demand, but it makes sense when you think about if you're going to more of a just-in-time and you have to prioritize cargo, then you're using those priority services as an outlet. So we're seeing increased demand on that side, but on the East Coast side, definitely been softer than it's been in years prior.
Yeah. Thanks for providing that insight. Want to talk a little bit more about that, but I think before we jump into kind of the year in review and talking more about what we expected to happen in 2025, what actually happened, it would be good to touch on the news coming out of Venezuela. Lars, do you mind giving the update there?
Yeah, I think it's important at least to touch upon, because geopolitically in the headlines, of course, this takes up a lot of space. I think everybody's watching what happened and what's going to happen with Venezuela. If we put our relatively narrow lens on here in the podcast of looking at it from a container shipping perspective, the most important thing to take away from this is, for container shipping, this is an event close to, of course, if you're shipping directly to and from Venezuela, you could be impacted. But the thing to note here about Venezuela is the overall volumes involved in Venezuela are small, both from a global perspective, but also if you look at it in a Caribbean perspective. There are no transshipment hubs, so there's no transshipment operations that are impacted, and none of the actual sailing routes the ships follow actually cross through Venezuelan territorial waters either. So unlike, for example, the Red Sea crisis and other crisis that we've had, we could talk also say the Taiwan naval exercises just a week or so ago that China held. Venezuela is large geopolitically, but specifically from a container shipping perspective, this is not really impacting. Even this morning, we're seeing vessels, if you follow them on their AIS trackers, they're still going into Venezuelan ports, going in and out. So it's a huge geopolitical event, but it's one of those events where it's not really impacting container shipping directly.
Yeah. Well, it's good to hear. Oftentimes we have a lot of impact from the geopolitical news that we hear. So relatively small impact, I think, would be a good thing for us. All right. Awesome. So let's talk a little bit about year in review. We tend to do this at the end of each year, talking about what happened in the previous year. So maybe, Don, I'd like to hear from you in terms of what we expected to happen in 2025. Take us back to the beginning of the year. What was the mindset of everyone? And then, what happened? What were the standout moments of 2025 for the shipping world?
Yeah, and I don't know that shipping is unique in this sense, because there's a tendency to say, what's happened in the recent past is going to continue in the future. But at the beginning of the year, we were really focused about the strike situation, what was happening with the ILA, and were they going to go out for a period of time. And there was some pretty strong rhetoric coming out at that time of the year. But that was, more or less a speed bump. And we had expected a fairly normal shipping cycle, which I guess is sort of foolish in this industry. But then again, how can you predict some of these events that have happened? But then what we saw in April was this trade war, which had a significant impact for us. The direct impact is that we suspended some services just because there wasn't the demand there, and operating a vessel at 20% capacity isn't going to work. And you saw things resume in May, and then you saw a very strong market because it makes sense that there was some demand there after the implementation of the tariffs were postponed. But then you saw sort of this like up and down spike and then a big drop. There wasn't really a peak season this year. I don't think we could call it a peak by any stretch. And then I would say in general, it's been a relatively soft market. The other thing that's happened, and there's a lot of discussion about the Red Sea, and you see some carriers testing around about going through the Red Sea. And I think that's something in the future that we can talk about. What at least my perspective is. We haven't done anything yet with respect to the Red Sea, but I think that's the other thing that's not top of mind for us. But post trade war, it's been a soft market, and largely for the reasons I already explained. Is I think there's been a shift in sourcing patterns from BCOs, which is again impacted demand on the shipping side.
Lars, let's switch over to you. So take us back to the beginning of 2025. Were there things that you agree with Don in terms of this is what we kind of expected, this is how it played out, and it ended up being different? What are your thoughts there?
Yeah, for parts of it, yes. Of course, a year ago, all eyes were focused on the potential strike on the U.S. East Coast, which fortunately didn't happen, which was good. We all knew that we would have a Trump administration coming in around January 20th. There was also in the market some sort of expectation we might see some trade war action, but I don't see anybody foresaw the magnitude of the trade war that then impacted, both in terms of the scope, with how many countries were impacted, with the magnitude, with the speed, not only of starting the trade war, but everyone has been caught by surprise time and time again during 2025 as to how rapidly conditions then change. And even the speed of the change itself changed over the year. When we had the so-called Liberation Day, it was still with a lead-in period of, I believe it was 5 or 6 weeks, with more lead-in period for cargo that was moving on water. Towards the end of the year, the norm became changes in tariffs with only a few days of warning. We actually, towards the end of the year, had a few tariff changes that were retroactive back in time. So the ferocity and speed of the trade war was something that was entirely unpredicted by anyone, as I see in the market. That the Red Sea routing didn't open was probably very much in line with most expectations that we also saw about a year ago. There was not much hope at that point in time of an imminent solution. In terms of the market, I might see it slightly differently, but feel free to chime in there, Don, because you're saying you see the market weak, but I would assume that's because you're looking at it especially from a U.S. perspective. Because when I look at global market developments, yes, demand in relation to the U.S. has indeed been weak, of course, in part due to the U.S. trade war. But when I look at demand developments in most other places around the world, Asia, Europe was strong. Asian trades were particularly strong. So the demand developments I see in 2025, except for the U.S., were actually very strong and also much stronger than anticipated.
Yeah, I think that's a great point, Lars. And I think as we face the opening of the Red Sea, the one byproduct of that is that you're going to have more capacity available, more ships available, because you just don't need as many vessels to run the loops on a weekly service. And the question becomes, well, what happens to those ships? And I think there's some thought, at least what I read, is that those are going to be deployed in the TP trade. But even when we saw the trade war start, the services that we suspended, those vessels went into other trades. And to your point, there is strong demand in other trades. And my guess is that, at least from a Zim perspective, we would redeploy those vessels in other trades. Again, not determined. I think a lot's going to depend on the timing of that, where it makes the most sense. But there's definitely demand in other parts of the world where we could see that capacity being utilized.
And one thing that's potentially also worth mentioning, of course, a year ago, we were also looking at an imminent redeployment of all the main services except for Ocean Alliance, as we had the new alliance structures come into place. And that went, all things considered, quite smooth. The transition went well. One of the byproducts was likely exacerbating some port congestion issues, especially in Europe, as cargo was then routed through different ports than it used to. But on the positive side, the phasing of the new alliances actually led to a significant increase in schedule reliability across most of the carriers that were involved, some more than others, but there was a lift across the market in terms of reliability. Granted, if I was a shipper, I would still not be happy with the levels of reliability in the market at large, but it is better. And what I think is important to note here is also there is now, compared to where we were a year ago, much larger differences between the individual carriers' performance. So if you look at it trade by trade rather than the global average, the difference between the best and the poorest performers in each trade lane is now larger than what we saw previously. And of course, if you look at it globally, you always have the usual suspects at the top and the bottom of the list. But when you look at it trade by trade, it's actually very different. You got a large number of carriers that actually end up in first or second place in different sub-trades. So you have a huge variety right now of performance levels out there, also more than what we had just a year ago.
Yeah, it's interesting to look at. I think you've got carriers that specialize in particular regions. But yeah, it is kind of interesting too to see the new alliance come out pretty strong in its first year. And overall, 2025, it was a pretty volatile year when you look at all the things that have happened. So you've got the new alliance, Red Sea, the trade war, all the tariff updates. And then as a consequence of that, like Don mentioned, you've changing patterns, shipping behaviors. So it's definitely a very volatile year. So when we look into 2026, do you all anticipate a lot of these same things continuing? Do you think the shipper behavior will probably stay in this more just-in-time mode? The Red Sea might be opening up, so obviously we'll have some changes there, especially related to capacity. I think my personal prediction with the tariffs is that you're not going to see as drastic of changes in demand because I think shippers are now expecting and have been expecting to just, be suddenly alerted of new, really large tariffs. It could happen, so you're not making big decisions in your sourcing. So I'm curious what you all think about 2026 in terms of your predictions.
Yes, I mean, the shippers now know it's par for the course. And again, this is specific to the U.S. It's not really an issue in all of the trades, but they've become accustomed that tariffs are unpredictable and they're already now acting accordingly. And I think it's going to take a long time before they revert back to their old selves and have some sort of faith that the tariff landscape will suddenly stay constant, because that will in itself require constancy in the tariff levels for a substantial period. And as I mentioned initially, we start off the new year with yet more changes in the tariff landscape. So for that part, of course, it's par for the course. Where shippers will have to then very, very quickly course correct is if the Red Sea routing reopens. And unlike a year ago, it now seems that there is actually a realistic chance that we will see 2026 being the year that we revert back to a Suez routing. I would caution that it's not a given. Yes, we see CMA CGM has ramped up significantly, running not all, but most of their services now. The big Asia-Europe services, their FAL 1, FAL 3, they still go around on the head haul. We'll now see Maersk doing trial shipments as well. If things remain calm and stable, yes, we could see a reversal. But that's exactly where all the shippers that are then using, especially the Asia-Europe route, we're going to see them course correct very, very rapidly, because they're going to see a contraction of their supply chain in terms of time, which is going to lead to a spike in their on-site inventories. That is going to then force them into changing their sourcing. For a while, they might then hold new orders out in Asia as they try to get this supply chain contraction under control. You would also have shippers that would very likely look at the landscape the moment the dam starts to burst and becomes clear then that shipping lines go back to Suez routing. They're going to be forced to choose, do I want to stick with my bookings or do I suddenly want to shift my bookings to the services that actually go through the Red Sea? And at least my expectation would be that there would be a shipper pressure to move cargo towards the shorter routes, which in turn would push the carriers towards a more rapid transition than what operationally would necessarily be the best thing to do.
Yeah. Don, what about your thoughts for 2026?
Yeah, and I'm probably just want to put a caveat here. I'm very bad at making predictions. So anything I would have predicted for 2025 was probably wrong. So just take that for what it's worth. I think Lars is right. I mean, Red Sea is top of mind, and I think it's more likely than less likely you'll see carriers return to the Red Sea. Again, when exactly that's going to happen, I think it's still going to take some time, but I think it's reasonable to expect that's going to happen. And then the question is, what happens with those vessels that you get back from doing that? I think trade war, that's still not a settled issue. Things keep happening with the tariffs. Feels like right now we're more in a relaxed stage that we're withdrawing things more so than increasing things. But as we've seen, things can change in a moment's notice. So I think that unpredictable component of shipping makes things a bit challenging. The one thing I would expect to continue is this drop volatility. And I think what you saw pre-COVID was these relatively minor increases. And I think what you've seen in the past couple of years, particularly post-COVID, is that there's these massive swings in rates, particularly on the spot market, because these increases are announced, usually a 4-digit number, something like that. There's peak season surcharges, et cetera. And, again, not trying to say where or when that's going to happen, but I think when space tightens up, I expect rates to increase, similar to what we saw in end of May and into June when the trade war was relaxed. Things to look for, I think the one thing that's really on our mind is the housing market, because the housing market has been one that's been a bit of a depressed market, just given the interest rate and the relatively high interest rate compared to the COVID years. And there's all these COVID mortgages that people don't want to get out of, which then lends itself to a less than typical housing market pattern, which we've seen for a few years. And I think there's a number of different industries impacted by that. We've seen the interest rate improve for somewhere closer to 6% these days than upwards of 7% that we've seen in the past. But that's something that could certainly unlock some demand, because from the furniture, home improvement segments, some markets haven't been so strong. And I think once housing improves, unless I read anyways, predict that there's a significant demand that will occur once the housing market breaks. So the other thing to talk about is just on-time performance, and that's a question of how things will improve. With the Gemini network, I think they've done pretty well, at least that's what I've read. And then you see other carriers in different places. Zim in general hasn't done so well overall. And I think that has a lot to do with our limited network, because we don't operate in every trade. And when we have delays, we're more heavily impacted than those that, let's say an MSC that has 7.5 million TEUs. That's not going to impact them to the same extent. But what Lars talked about earlier is you double click and look into the individual segments. You can see, for instance, our Asia to West Coast product is somewhere around a 99% on time rate, because again, that's a priority service. It's important for us that we have reliability there. I mean, some of the LATAM trades where you have a high level of reliability, but those services that touch the Caribbean tend to have some issues, whether it's in Cartagena or Kingston, which can delay a vessel here or there, which then impacts your overall improvement. But the shipper response to on-time performance and the importance of that is going to continue to be something that is looked at. And when you talk about, if my sourcing pattern is more just in time, then the reliability of the carrier becomes more important, because again, I have these lean inventories, so I'm going to be more conscious of that. And so how that all ties together is something that certainly we're going to watch going into 2026.
That's awesome. Thank you for sharing that. I also want to swing back to what you were saying about the rate spikes and the patterns that we were seeing throughout 2025 and expecting that to maybe continue. I think that makes the NYFI indices more relevant for some shippers. Over 2025, we of course released Asia to US West Coast and East Coast, transatlantic westbound. We also had North Europe and Mediterranean to US East Coast, and Asia to North Europe. For 2026, we're planning on releasing Asia to East Med and West Med, Trans-Pacific westbound, Asia to South America West Coast and East Coast, Asia to the Middle East, and then Middle East to Europe. So we'll be able to track some of these at a more granular level. You'll be able to see these rates change and use it for all sorts of trade lanes that our shippers and listeners are using. One other note on that, so we will be hosting a webinar about hedging on index-linked contracts, probably sometime in January or February. So be sure to find out more information about that on LinkedIn in the coming weeks. But is there anything else you all want to add before we sign off today?
Yeah, just a couple of things. I want just to follow up on your small outline here of the NIFI index. What I think has been very interesting to watch here during 25 is it's the first time ever we've had the ability from an analytical perspective to look at the very real difference between quoted rates in the market and then actual paid rates in the same spot market. And it also turns out it is very clear that at times there's substantial difference between the two, which at least from my perspective also means if you do want to go down the path of doing risk management by having index-linked contracts, and there are clearly a lot of shippers that want to go down that path, it does make sense to do your homework and look at which index actually shows most clearly what I as a shipper am experiencing. So you don't choose an index that's, for example, more volatile than the rates you see yourself. And that's where measuring actual loaded rates is not as volatile as what you would see in, for example, quoted rates out in the SCFI. The other thing I would like to add, and this is again adding to this uncertainty turmoil for 2026, we've been talking so far about the US trade war as if it's one-dimensional issue in terms of tariffs, but it isn't. It's a multidimensional issue. We already saw that also in container shipping with the USTR fees, where the US first introduced fees on Chinese vessels. China retaliated by threatening similar fees on US vessels. The very real consequence was redeployment of vessels across the carriers. Now, this has been postponed to October 26, which means it will for sure rear its head again. Also, already in the works, in 2025, the FMC in the US was charged with investigating whether there are unfair trading practices from various flag states. And I can already guess the conclusion is going to be yes, because there are very, very different conditions depending on flag states, especially the ones we tend to call flags of convenience. The only question is, what will the US government then do? And I would assume they would go down the same path and then trying to do various types of punitive measures depending on flag state all of a sudden. And we're going to have another round of turmoil, another round of how do we move ships around? The ship's going to be reflagged. And on top of that, I mean, we started this and might be a good place to also then end with talking Venezuela and geopolitics. Now, Venezuela itself doesn't have any impact on container shipping, which is the fortunate part. But we have plenty of issues already looming here. We still have the whole issue with China out in South China Sea and around Taiwan, which again, we saw this massive naval exercise just a week ago. So that is still looming high. The Red Sea we already talked about. But of other more predictable trouble spot, we still have the whole issue around Iran, which again leads to a ripple effect of potentially impacting the Strait of Hormuz. It's not a given that the Houthis will lean back and say, okay, we're now happy, we're going to reopen. I think that should be the baseline, but we cannot be guaranteed. Again, getting where I am, we suddenly saw the Greenland issue come again. From a container shipping perspective, Greenland is a non-issue. But if we think back almost a year, at the same time as Greenland, what reared its head back then? An issue around the Panama Canal. I would not dismiss that that would also be another topic coming up. So the geopolitical impact on flashpoints that will also impact container shipping. That impact, we're likely going to see more black swans on that one emerge also here in 26.
Yeah, that's a good call out right at the end, Lars. The whole world, all the conflicts and and geopolitical things. But no, you're right. Some of these things that we didn't really touch on too much in the episode are still things we need to keep an eye out on in this upcoming year.
Yeah, when I think about next year and just to wrap, I think Lars is right. I mean, we talk about the trade war. It's certainly not one-dimensional. There's a lot of different things which impact the carriers and shippers, STR being one of them, but just tariffs and other things. And again, is there something else in the works? Again, it's hard to predict these things, but certainly there's reasons for concern. I did want to touch on index-based contracts that we are hearing more about that than I think we've ever heard about before. So there seems to be a lot of interest in it. I think a lot of people, it would be their first time doing it. So there's a lot of discussion around how exactly it would work. But from an interest level perspective, I could say it's very high. And the one thing I didn't touch on for 2026, and I'm not sure how much of an impact it's going to be, but there's all this talk about AI and how AI is going to impact the industry. Mostly what I've seen are a number of clever pictures by AI. That certainly seems to be the primary use case. But outside of that, there is a world where when you think about offshoring, that there is an opportunity to perhaps replace some of that offshoring with AI, because you could structure a set to run similar to how offshore centers work. Again, not sure how far away that is. I mean, that's a debatable point. I hear different things, but I think at some point AI will be. It's there to some extent, but I would say it's not completely taken over any particular segment yet. But I think it's reasonable to assume that is it this year, next year? I would say it's soon that it seems like it's going to have more of an impact.
Yeah, fair point. I think one of the things in our industry is the quality of the data. So I would assume that it would take a lot longer for us to be able to really utilize AI in a super meaningful way. We've got to kind of clear that up first. Garbage in, garbage out. Well, thank you both for the insightful episode. Don, it's great having you on as always. And Lars, we've been doing this for almost a year now. It's crazy. It's been super fun. I've been able to learn a lot from you. So I really appreciate, having the option to do this. Thank you to all of our listeners. We had, I think, 40,000 downloads last I checked. So it's really neat to see the podcast grow. So thank you for subscribing and listening in. And we'll be back next week. Bye, everyone.
Thanks. Happy New Year.
Thanks. Happy New Year.
Thanks for listening to Supply Chain Secrets Podcast, presented by Nice Shacks. Be sure to subscribe on your favorite podcast app. Want to be a part of the show? Register to attend a live recording at the link below.